and not another conference call line.
How'd you get that paid? How'd you get that paid? That's the first one.
All right, so that's one of the problems is whatever you got up starts to click in there and bother you. So I'm just going to get out of Bloomberg so I won't get hassled. All right, so here's the agenda. First of all, we're going to go through a quick review of CLOs, which is the stuff that we talked about the last time. If anybody needs that presentation, not right now, but after this, I can send it to you. It's got a lot more slides in it than this one does, and I'll also send you this one after this presentation. The idea is for everybody to ask questions, and the reason I do it by a presentation thing is so that I can like move my cursor around. Hopefully everybody sees it. You know, this is a new service. I'm using Join Me. I'm not sure how fast the internet is for those guys, so if something doesn't come up on your screen and it sounds like I'm talking about a different slide, let me know, so I'll wait and then it'll finally show up on your screen is usually what happens. And also, you probably ought to X out anything that takes up a lot of RAM because the experience has been that slows down the rendition of the slides. So we're going to go through the quick review, then we're going to get into client conversations, ask questions, and then CLO equity, how it works, why it's different, and then I'll just entertain any other questions of any type afterwards. And you can ask me questions anytime during this presentation as well. So let's see. All right, so one of the original slides that we had, it looks like it's too big, so I'm making it smaller so it fits. All right, so this is one of the slides from the first presentation that we did. This is the basic structure of a CLO, and it doesn't really matter, like for this slide, it doesn't matter if it's CLO 1.0 or 2.0. But anyway, the basic idea is, first of all, you have a portfolio of assets. One thing this slide doesn't show you is that these assets are constantly changing. And they're going through this offshore special purpose vehicle, all that kind of crap. But what you have coming in is you have principal and interest. So the principal would be prepayments for the most part. And then you just have interest. And this is coming in quarterly. And that is going over to pay down the CLO bonds, which is what we sell, okay? And it pays them down from the top down. And the first part of the second phase of the CLO is an interest-only period. There's no principal getting paid down because it's called the reinvestment phase. So they'll be reinvesting any principal that comes back in here. But the thing to note here, since we're going to be covering CLO equity later on, is that the interest slides down to the bottom here, and that's what the CLO equity gets paid. And then someday they might get principal, but they're not really counting on that. So what I wanted to point out is that there's a big difference between what is being paid into the deal by the assets, which are bank loans. That's why I have this example bank loan on the left side here, and what's being paid down to the bonds. And I just showed what the coupon would be on the AAAs, right? So it's about LIBOR 3 months plus 155. But anyway, you can imagine each one of these probably goes up 20, 30 bips per class until you get below investment grade, and then you get to like 450 and 700 for like double Bs and single Bs. And then there's no rating and there's no coupon on the equity because it's equity, right? But if you look at what's paying in, so a typical loan might be like $2 million. It's got a loan X ID, which is like a QSIP for a loan. The coupons, LIBOR 3 months plus 550 because these are all single B and double B loans. So basically they're high yield loans. If these are securities, this would be a junk bond. But because they're bank loans, they're not considered securities. Now, one thing to note here is they usually do have a floor. So this has got a floor of 100. So that means that if LIBOR drops down so much that it'll never get below 100, right? So that's, and then it'll have a maturity of 5 to 7 years, and facility size, which means how much was issued and outstanding, is, let's say, $650 million. That's just a round number. And the percentage of the CLO, this deal, that typically represents, and I put this in parentheses because now I'm talking about the deal, I'm not talking about the bank loan. The percentage of the deal that it represents is, let's say, plus or minus 1% would be typical. If you see something that's a lot over 1%, that would be considered like an aggressive manager. He took a big position in that particular loan. If you see something that's way below 1%, that's probably something that he bought close to 1% and it turned to shit, so he sold some of it. So anyway, the other day, if you remember, Mike sent out some article about the problem that people are having, equity guys are having, with LIBOR going up, because LIBOR's been going up slightly. And I could sort of tell from the way the article was written, it was New York Times, that the writer himself didn't even understand what the problem was. But here's the problem. The problem is that these loans have a LIBOR floor on them, right? But the bonds that we're selling don't have a LIBOR floor. So that means all that excess interest, what I call IXS, is flowing down to equity, right? But if LIBOR goes up, then now this guy is getting less excess interest flowing down because the floor is still here, but these guys got no floor and no cap. So therefore, they're having to pay out more to all these bonds, and it's taking money away from the equity. So that's why we've been seeing a lot of equity being offered, a lot more equity being offered around or on BWICs than we have in the past. And okay, why is LIBOR going up? So that's another problem with the capital markets, where there's this new regulation coming in on commercial paper that basically says that money market funds have to like price to an NAV, and have to advertise that they're not guaranteed to be $1. So every day they're going to price it 999.99 cents or something like that. So the fear is that a bunch of people are going to pull out of money market funds, and that's what's driving up short-term rates, and that's what's driving up LIBOR. But anyway, we'll know all about that on the 14th of October, and who knows what will happen. It could all calm down afterwards. Okay, so anyway, that was one point I wanted to make. All right, now CLO 1.0 versus 2.0. The big picture here, I got these bullet points here that tell you what the difference is. You can see that what they did in, 2011 and forward is 2.0. There was hardly anything issued in 2011, so it's really 2012. But basically what they did was they increased the subordination to the AAAs. This is the subordination, because losses come in the bottom, okay? So the losses are so the AAAs are much more protected than they used to be, because now they issued AAs that are 10.8% of the deal when they used to be 6.4%, for example. And then they also threw in like triple Bs, double Bs. They also threw in single Bs. Whereas before, there was like a smidgen that used to be above the equity and below the investment grade triple Bs. So anyway, that's the real big difference. The other somewhat minor differences are there's no bonds in a CLO 2.0, and there's no other structured finance notes. So like just today we were looking at this CLO 1.0 that I used to own when I was at Dalton, and it's got like 4 or 5 structured finance notes in it. In other words, other CLOs in it. And you're not allowed to have, well, you can have that in a CLO 2.0, but it's not going to qualify. The reason is the biggest buyers of these AAAs are banks and insurance companies. And at least the banks can't buy something that's got a security in it, which would be a bond or another CLO loan, another CLO bond or a second lien bond or anything that's a security. They'd have to put extra risk-weighted capital against it. So basically, that means that nobody that wants to qualify for CLO 2.0 is going to put anything other than loans into the deal. So now how are they going to, they want to play the spread so that they can get the maximum spread on the asset side. So when I'm talking about, loans only, I'm talking about the asset side of that picture above. So how are they going to do that? Well, they're going to put in second liens, and also they're going to dip down into the single Bs, let's say. And some of those single Bs might turn into triple Cs later on. But basically, they got to get the spread to make this thing work for the equity. Otherwise, they're not going to get the equity guys to sign up. And what the AAAs want is just a function of the market. And LIBOR plus 155 is very good compared to other structured product stuff that is being new issued out there. It could be like 3 times what a AAA, automobile type of deal is, or a credit card deal or something like that. But anyway, so that's what's going on in 1.0 versus 2.0. Let me see if I can use the page down here, and it'll work. Yeah, it does. All right, so there's some terms I went through last time, and I just want to go quickly through these this time. So there's the over-collateralization test, and we didn't talk too much about that last time because we were all focused on this MVOC thing. But basically, what these deals have tests that determine which way cash is going to flow, like whether the next tranche below them is going to get paid. So the test is based on the par value, which is the historic value of the bond. It's not even based, if the guy bought the bond, or the loan, if he bought the loan, if he bought the loan at 98, it's not based on his price of 98, it's based on 100. It's based on face value. But these are the tests. So that's why OC test cushion matters. OC test cushion matters because that's where cash is going to start to be diverted from somebody. Now, the other big term here that we've heard about, and this shows you how you calculate it, at least for the Class B MVOC, is MVOC, okay? And basically, the only difference between par over collateralization and market value over collateralization is the pricing the assets at market value. So now, the guy who bought that single B to make his deal work at the beginning, and now it turned into a triple C, or maybe it's, O-rig or C-drill, it's priced at 44 cents, okay? So you're going to put, instead of putting the par value, the 100%, or, 100 cents on the dollar, he's going to put 44 cents into this calculation, and that's why it's called the MVOC. And the reason that people look at this is it's a quick and dirty way to compare deals to see if something that you're looking at is within a range of quality that you would be interested in. You can have deals that have very close MVOCs and very different portfolios. That's why you got to look closer. But anyway, that's what MVOC is, and that's what the OC cushion and OC tests are. And on the next screen, we'll start to see where the par value tests come in. All right, so this is just the interest waterfall. And, first thing that gets paid, of course, is fees and everything. Then A gets its interest. And then there's this Class A par value over collateralization test. There's also maybe an interest test, but those tests, never fail as far as I've seen. So anyway, the only thing you need to worry about is par value tests, okay? So anyway, if the test passes, fine. B gets paid interest. If the test fails, then the interest goes to Class A principal. It becomes a principal payment to the Class A's and pays them down until the test cures, okay? And then B is going to get interest. And that's how all these tests work all the way down. And you even have, there are deals, like I've been pointing out deals that we've had on offer where they've got a single B over collateralization test. This is very unusual, and the reason it's good, you usually find them in 2012 and 2013 deals, or ugly managers of 2014 deals, let's say. But anyway, the reason that it's good is it protects all the bonds above it, right? Now, it's good for the bondholders, but it's bad for the equity, if you think about it, because the equity is the one that's going to get cut off here. So anyway, that's something else to think about when you're trying to figure out CLO equity. Anyway, so the important thing is MVOC is a quick and dirty way to look at something. It does give you a quality indicator. There is a very strong correlation between MVOC and discount margin, which is basically the price of the bond, of the CLO bond. But it's par value OC that cuts off cash flows. So, you want to look at that too. And there's two ways to look at that. One way is, what I do is, it's called break even or break CDR. You figure out what's the default rate that it's going to take to break this bond to get to the class that you're looking at. Usually, we're looking at single Bs and double Bs, sometimes triple Bs, okay? So it's basically reversing index and saying, what default rate would I need to lose $10,000, because that's the number I put in there, otherwise it hunts around forever. What default would I need? Default rate forever. In other words, it would have to be this default rate every year continuously. And a lot of times it turns out to be like, it would have to be a nuclear winter for that to occur. But anyway, break CDR is one way to look at it. Another way to look at it is that OC cushion that was in this slide here. You can look at OC cushion. And sometimes it's easier to do that because Intex can now sort stuff by OC cushion. So you can find out, like, how does this guy rank in OC cushion compared to other guys. All right, so now a little more words. We're going to talk about equity later. One thing they do look at in equity is the NAV of the equity. And the reason NAV, think of NAV is, if I bought this equity today and I sold it, you can think of MVOC the same way. If I bought this equity today and I sold it, what would I get back? So basically, they're pricing all the assets, all the bank loans, at market value, and then they're saying, how much do I get back? And for the calculation for the equity or the subordinated bonds, equity and subordinated bonds are the same definition as far as I'm concerned. What they do is they take the notional value of the equity and they divide it by what's left over. So basically, it becomes 605, which is the total amount that's above this equity, less the 552, and then divided by 60, which is the amount of equity that's outstanding. And the 605 is the market value of the portfolio. And then, that other number, the 552, is just adding up these other values here, okay? But anyway, so equity, that's what equity NAV is. Nobody wants to buy something at NAV because that means you're not getting anything, but par. That's like buying it at 100 cents on the dollar. So, they're going to buy it usually at a significant discount to NAV, and that depends on how long it's going to be till supposed maturity. The reason I say supposed is the guys that are going to pay the equity are the last guys standing. So that means that they're all the guys that defaulted and came back to life and all that kind of stuff. But anyway, we're going to get into a little bit of that later. All right, another thing that I wanted to go over is the standard deviation curve. And this is a measure of performance. You'll see me, and in the next slide, I'll show you, where I put out, like, what's an axe look like, or what's a cell chat window look like when I put it out. And usually, it'll say CCC% and below. If I say now I'm putting the percentages in. I'm just guessing at them. But if you see me say one standard deviation, that's equal to 68%. So if the guy has CCC and below, that's one standard deviation above, that's bad, right? If he was one standard deviation below, that would be good, okay? But you don't want to have more CCC, you want to have less, okay? So now if he had MVOC that was one standard deviation, or he did 68% better than all of his buddies that put CLOs out in the same year, that would be a good thing if he was above, okay? So it depends on what you're looking at as to whether or not being above or below the standard, a standard deviation, or how far above or below is good or bad. Now, two standard deviations is 95%. I've never seen two standard deviations. You rarely see anything that is, in a good way, out by more than one standard deviation, okay? I've seen a few that are like 1.2, 1.3. They're usually to the bad side, it's something bad that they're out on. And 3 standard deviations is basically you're covering every possible outcome under this curve. That's like dial tone reliability. That's like picking up your phone, maybe your cell phone, let's say. It's like picking up your cell phone and not getting a dial tone. That's what 3 standard deviations is, or 99.7%. All right, so let's see. Here's like an offer example. So we got 5 million. This is the Bloomberg ticker symbol. Has everybody got this slide on their screen? I hope. Okay, anyway. So I guess the slides are going through at the right speed. So you got ICG 2014 2AE. We're currently offering this, I still hope. The offer price is 84, and since these things are LIBOR plus something, the way you talk about price is by DM, which is discount margin. So what discount margin is, it's kind of like saying yield. But the idea is you hold LIBOR constant, and then you just vary the spread or the discount margin. So this really means you're getting LIBOR 3 months plus 825 if you bought this bond at this price, okay? And that's in a certain scenario because you're putting assumptions into Intex, like what are prepays, what are default rates, how long does it take for default to recover, and then what percentage recovers. And then what happens to the defaulted deals that are already in there? Do they go to zero? Do they go to something else? And then suppose the loan ends up being longer than the deal is because it got defaulted and then recovered, and now you got a new loan, right? But its end date, its maturity, is longer than the deal. So then you got to go input some sort of liquidation value. So anyway, the point is there are a lot of assumptions, and there's some standard assumptions that people like to use. And, I call that the quick and dirty look. So this is my quick and dirty look on this bond. And that means I didn't do any overrides on individual loans, which a guy that's buying it would do. But anyway, this is a quick and dirty look at it. The MVOC is 104.2, which is not too bad. It's not great for, this one's a double B. I guess I didn't put that in here. All right, anyway, it's a double B, but, that's not too bad. It could be a lot worse, right? The OC test that I talked about, what's the cushion? Well, it's at the mean. In other words, it's in the middle of that bell curve, and it's at 3.5%, okay? So it's right here. Now, is OC cushion, do you want to have more OC cushion or less OC cushion? You want to have more, unless you're, yes, even if you're the equity, you want to have more. If you're the equity, you want to have more because otherwise you're going to get cut off soon. So this guy's at the mean. Now there's something called par build. All right, so that's like these guys are buying and selling these loans. So now if they buy a loan, they could buy a loan cheap and hope it's going to go up. And if it does go up, then that's going to increase their par, and that's going to help them out with these other loans that they bought that were single Bs and they went to shit and became triple Cs or defaulted. So par build is like how successful have they been at increasing the par of the deal over the life of the deal for that vintage compared to everybody else that issued something in the same year. The reason I always look at the same year is because it's like guys fishing in the same pond, okay? They've got the same opportunities. They're going through the same storms at the same time, basically, and they got to manage through it by buying and selling. Par build, they can do something. You can increase par, but you're not going to change it by 15%. You might change it a bit, but you're not going to change it by a lot. But anyway, so this guy did better than 60% of the vintage. So then I talk about triple C percentage or less. That's what this means. So there's 12.8%. Now in this one, I didn't go look at the standard deviation or the percentage or anything. But what you do have here is you've got 12.8% of the portfolio is triple C or below, but you got the price average for that. And the price average is 89. So that says to me, this guy's got a pretty good quality triple C bucket. Okay? So now another standard to look at is prices less than 80 and prices less than 70. Some people think that anything less than 80 is trouble. And it could be, but now standards are getting lower because people are getting hungrier for yield. So they start to go, what's the price below 70, okay? What's the percentage of the portfolio? So in this one, if you look at the difference between these 2% numbers, what it means is most of this stuff is between 70 and 80. So, and then you look at the average price, and you kind of go, okay, this 65 price, you know, is that good or bad? Well, you know, it's not bad, it's not great. You know what I mean? It could be a lot worse, but this 52 is pretty bad. Luckily, it's only 4.6% of the portfolio. Things rarely come back from a 52 price. I mean, you guys that are doing corporates know that stuff, right? But, you know, there are exceptions to everything. So that's oil and gas. So the next thing is oil and gas. Everybody wants to know the oil and gas. 1.48%, that's low. That's a pretty low percentage. Now, maybe he got there because he destroyed it. He sold it. Maybe he had a lot more when he started out and he sold it, right? Maybe that's how the par value, you know, got down to where it is. But anyway, what he's got left is 1.5%, and it's at 55, let's call it. Okay, so that's not too terrible because it's not a big percent, even if the price isn't great. The other one that everybody's interested in is metals and mining. Metals and mining, this one's got 2% metals and mining. I'd say that's good. And he's also got like 74, almost 75 type of average. And so that means like he doesn't have too much and it's not too ugly. But, you know, it's not at 89 either, right? So then the last thing is retail. Sorry about that. That's my sync to Chris's cloud. Anyway, so the next one's retail. People used to be focused on retail during the crisis because retail was going to hell. Right now, retail is doing well. So it's almost like you wished it back in 2014 that the guy had focused more on retail than he probably did on oil and gas when he started this deal. Because right now that stuff's at 95, right? So that's what one of my CLO offers looks like. And now we get into questions and conversations. So here's the situation. Let's see. So we're half hour into this, or just about. So the situation is you're the sales coverage on an account for CLOs, but you haven't called them since Odeon last had a CLO analyst. What are the key questions to ask? So, does anybody want to volunteer anything? Like some of you guys that have been around for a while, Randall.
Yeah. Okay. Well. Okay. Looking at what you just talked about, like your how much of the loans are in each sector, or you know that kind of thing. It would be helpful to me to know if there's 1.6 or there's 6% in retail. I think you said. Like, what does the average for that vintage have? Does that mean 6% is a lot in retail, or a little bit, or about the mean? Because you often compare them to the mean or the average in the vintage. I would be interested to know how much, oil and gas is normally. Like maybe a third column in the middle, percent oil and gas 1.48%, oil and gas in the average guy's CLO.
But see, that's what you want from me. I'm saying, what would you ask your client? You can't ask your client that. He probably won't know the answer. That's the value added that we can add, is we can tell him, look, this is 68% better. I mean, some of these clients that are sophisticated, they're going to have the same tools. They're going to have better tools even. But, he's not going to know the answer to that question. But, yeah, I should give you that information. But what questions are you going to ask your client?
How flexible are you on price?
How
much room do you have on that offer?
All right, Joe Falk, give me a primer. Give me a question.
Where are you buying in the cap stack?
Good one. Okay. All right. I'm just going to move on to the questions and the answers. Okay? So, are you active in CLOs, and are you the right person to talk with on this asset class? A lot of you guys are calling RMBS guys. They may be the right person to talk to. They may not be, but they damn sure better know who is, and I bet they do. So that's a good way to find out, right?
Right.
Then the next thing is, assuming you get the right person, Do you invest in both 1.0 or 2.0, or is the majority of your activity focused on one flavor or the other? Because there aren't that many people that do both. The reason is CLO 2.0s are very clean. In other words, they're uniform. They may not be uniform in whether they got oil and gas or metals and mining, but they're uniform in the sense that you only got bank loans on the asset side of the balance sheet. And the reinvestment period is going to be like 4 years, which means the call period is probably 2 years. That sort of thing. So, and also CLO 1.0s, first of all, they got more complex stuff in it, or a little bit more. They're a bit harder to price, and also they've been paying down. So a lot of times they've got a lot higher protection, higher over collateralization, which gives them a higher price but a lower discount margin, which for a lot of our buyer base, let's say, the guys that were buying and selling double B and dirty double B and triple and dirty single Bs or any single Bs, those guys are not likely to be doing CLO 1.0s, or if they are, they're looking for some really high yield stuff. But anyway, so that's why this is an important question, and you don't usually get somebody that says, if the guy says, I do both, then you got to probe, because that's probably a bullshit answer. All right, next question. Are you more active? There's Mark's question. Are you more, or Joe's, are you more active in the upper or lower part of the capital structure? Why do we want to know this? Well, we really want to know it because, there's a range of ratings for all these different CLO bonds. The guys that are doing AAAs and AAs and single A's are probably, I try to rate clients' potential on like a 1 through 3, and I would rate that guy a 3 because it's not that he's bad, it's just that we're not going to do much business with him in the next 6 months. And that's my time horizon because the market changes very quickly. So anyway, so there's usually a split between AAAs, AAs, and single A's. Sometimes the guys will go down to triple Bs, also will be in the investment grade world. But a lot of times the triple Bs are held some by hedge funds or other guys, that are investing lower in the cap structure. Of course, they're looking for dirtier triple Bs. And a lot of times they end up getting them because somebody that can only do investment grade has to get rid of them because he thinks they're going to be downgraded or something. All right, another question. Are CLO managers that you prefer or would avoid? Are there CLO managers? Which ones? The reason is, that's like the next most important question. I mean, you can almost assume that the guys that we're talking to are in the lower part of the cap structure and they're doing CLO 2.0s, and you're probably talking to them about a CLO 2.0. So then the real question becomes, what managers are off of your list, okay? And I can tell you, we've got a lot of clients that have managers that, we're not going to be competitive showing them because they're not dirty double Bs or they're not dirty single Bs. They're super clean. They were done by Ares or CSAM, which is Credit Suisse Asset Management. But anyway, so that's another good filter. What managers do you like? What managers don't you like? Write it down and keep track of it. And if you're showing them something from a manager they don't like, make sure you tell them, I know you don't like this, I'm just giving you color. And also, like I said today on the chat, you guys need to pick up your phones more because the guy will give you more color on voice than he will on chat. And I don't know, we were talking to some guys in Paris today, and I started chatting them in French because I used to live there for 10 years. And these guys were eating this shit up. But anyway,
I think it's also of note that some guys will tell you they will buy certain parts of the cap stack of certain managers. Like, I'll go down to this level, I'll buy equity from this guy, but I would only buy like mezz from that guy.
That's a good point.
They will, I remember I had a client who was like, I can buy down to double B of this guy, single B that guy, all the way to equity on the third. So
that's a very good point. And because there are managers that are equity friendly, And what makes them equity friendly is the way they structure the deal. And their reputation. They have a reputation for being equity friendly. If you go on Ares' website, you can find a white paper that just talks about CLO equity and what makes a good manager. Okay, next. Are you typically asked toward clean deals, or will you look at dinged up tranches as well? So this kind of goes to Mark's point. Can you give me an example of something that you've recently purchased so that I can have my analysts take a look at it? I mean, that's always a great question, and it gets you through these guys that are saying, oh, yeah, we do everything. Yeah, we're up and down the cap structure, no bad bonds, just bad prices. Usually that turns out to be like a bullshit act, in my opinion. And also, you guys, especially guys that don't know CLOs, you should get me on the phone with your guy. I mean, I am not going to steal your client. I could care less. I like to talk to all the clients. I start telling them my CLO buy-side stories, and they usually like it, So anyway, get me on the phone. Even if you just got a guy that says, like, what do you guys do? Like it's your first call. And you go, well, can I set up a call with my analyst trader? And, the guy hopefully will say yes. I mean, we'll do it at his convenience, especially in the summertime. It's easy.
Sherman's a personable guy.
Yeah, Randall used to keep my dance card full. Yeah, he used to keep my dance card full. I don't know, Evan, when am I coming to New York? All right, so what's your typical bite size? Everybody's got a bite size. There's always 5% limits on hedge fund portfolios. I mean, it's almost imposed by the regulators. Like, the regulators will come in, and if they see something that's over 5%, the guy's going to have to explain that. So they never start out with a 5% position. So it's really like it depends on the size of the fund. But anyway, so that's why you want to know what their bite size is. And even if it's a micro size, we don't care. We'll still do that work because we're hoping that those guys are going to grow. And there are RMBS guys that are on this call probably that have examples of RMBS guys that were doing micro lots that grew into big companies, and the guy just is like their go-to person now. All right. Have you had much success sourcing or selling CLOs on BWICs? What I'm trying to figure out here is, are they playing in BWICs, and when do they play? A lot of guys just play when they're selling. They'd rather buy out at comp, But you want to get on their BWIC list because then we get color. The more color that we get, and yeah, we can get color through Empirisign and stuff, but if you're on their list, they give you more color, and also they take your call more often. So that's why I would like you guys to respond more to some of these BWICs, like try and get bids, so that we can at least show in a bid, because that shows the guy that's offering the BWIC out there, one day it's going to be your client, one day it's going to be the guy sitting next to his client. But it shows him that we're serious about this stuff, and then when you call him, maybe he takes your call the next time. Okay. Yeah, so that's what I mean by you should pay more attention to them in order to earn the right to show in securities out of competition. Because that's the key. That's really where, nobody makes any money on BWICs except the clients, I guess. Okay, so CLO equity. It's all about IXS, which is excess interest and control, okay? So what is IXS? Well, if you remember, what am I on? I'm on slide 13. If you remember this one, the IXS is the difference between this guy getting LIBOR 3 months plus 550 and only paying out LIBOR 3 months plus 150, okay? That's what IXS is. That's what gets down here to the equity. One more back. There we are. Okay, so IXS. The only other thing you got to take out of it is fees. And that's the fees that the manager's getting. And usually the manager gets a fee in the front of the waterfall, like before the AAAs, and then it'll get a fee at the bottom before it gets to the equity. So here's what I'm showing here is, we were showing this CRMN 214.2 or 214.1 and 214.2 had just traded, and everybody was whining that it was a better bond and all this kind of stuff. And, I was like, wait a second, let's look at this. If you look at when I say weighted average spread, that's the loans. Weighted average cost of capital, that's what WACC is. Weighted average cost of capital, that's the bonds. So if you look at this one, the guy's taken in 409 in spread, and he's only paying out 2.2 in interest if you don't look at the fees, right? That's a huge difference. All that difference is going to the equity. That's why guys buy equity. Okay? So now when you add in the fees, somebody was telling me, no, it's a different answer if you add the fees in. Okay, so I looked at it, so 2014-2, okay, it turns out here's the IXS. This is the interest from the collateral. Like on this one was 17.9 million, and the interest paid out was 10. And on this one, it was 18 and 9. So IXS on the first one is 8.7 million, and on the second one it's 7.8 million. So it turns out that there's a slight advantage, and this would be on an annualized or, quarterly basis, actually. This would be on like a quarterly basis that there's this difference. And, unfortunately it wasn't as big as I had hoped it would be, but it still was bigger. And what you can see is the difference turns out to be these fees. On one deal, there's a lot more fees than on the other deal. But anyway, so next thing on CLO equity. So that's where IXS comes from. So now, how do you price a CLO? All right, so what happens here is you've got the AAAs. And what I've graphed here is the AAAs are in blue. And this is the factor of the AAAs. Because once those AAAs pay down, remember that was the huge tranche that's only getting paid 155 basis points over LIBOR. Once those things pay down to a certain point, that's going to cut off the cash flow, which is what this red line is. It's the factor of the cash flow. So basically, I took all the cash flows, I added them up, and then month by month, I said, what percentage of the total is this, okay? So what you can see is this widens out, right? And this green line is just the difference between the two. And what am I looking for? I'm trying to figure out what day is the equity likely to call the deal. Because I'm going to price equity on a yield to call basis. So instead of looking at the equity as it goes on forever, I'm going to say at this price, what is my discount margin or my yield? Actually for equity, you just use yield because it doesn't have a spread. It just has a yield, really. So, discount margin wouldn't be the right concept. But anyway, so, what you can see here is the difference between the two is increasing, flattens out, and then it starts to fall off. So the guy's going to likely get rid of that thing. In other words, he's going to call the deal or refinance it or something somewhere around here, 5/20/19. Because that's where this thing starts, that's where the cash flows to equity start to fall off pretty, in a steeper way. And different deals will have different curves. Some of these can be really steep, some of them will be more uniform, or some of them have bigger steps, like, I don't know, I've seen like AA or AAA deals that had like a big step right here, and then it kind of got uniform again. And who knows? Maybe that's a bunch of loans that the guy bought that pay off supposedly all at the same time. Who knows? Anyway, so that's what this one looked like. This was a Catamaran 2014. And then I looked at another one, which was Avery Point. Oh, okay. So let me go back up here. Now, the difference is, if you have control of this deal, which means you own a controlling interest, more than 51% of the equity, then that means you control whether it's called or not. So you could say, no, I'm perfectly happy with this. I'm not going to call it here. Okay, so that's why control counts. So if it's not a control piece, then I'm going to do a yield to call type analysis. If it is a control piece, I'll probably do both, but I'm going to assume that the real one is that the guy doesn't call the deal unless the cash flows really fall off. Okay, so Avery Point, this catamaran one turned out it was an ownership interest or a control interest, and this Avery Point, wasn't. And this is just to show you that cash flows fall off at different ways. Like, look at this big step down here in the cash flows going to the equity, and then you can kind of see like this is like sort of uniform, but there's also a big step here. Okay, so that's how you price CLO equity, and that's it. I'm 15 minutes over my time, but I'm ready to take any questions and all questions and go back to any slide you guys want to go back to. I'm going to have to start calling out names. Somebody ask a question. All right, no questions? Let's see, who's out there? Jonathan.
Hey, Mark.
Who's that?
No, this is Mark. Why don't you, if you wouldn't mind, it's a little noisy.
What do you think
here.
you guys would like to hear, Mark?
Well, I would like to hear when you're talking about valuing, trying to sell someone in an equity piece, and usually it's like, NAV plus certain number of dividend payments.
Right.
As far as how, if you could maybe go over how buy-siders look at that, because it's usually, NAV plus
okay.
a certain,
so
3 years, 3.5 years, 4 years, and why they look at it that way.
They're looking at it as an IO. And I don't know what the thumb rule is now, but, when I used to look at IOs, not CLO IOs, but just like anything that was like an IO, like say it was some franchise loan or something, IO, usually you go, I'll pay 5 payments, And in CLO equity, it's more like they'll take like 8 or 9 payments is more typical. So that's like 2 years, okay? And I did calculate that number for these deals, and they were like 11 or 12. But that's based on my assumptions of what the payments are going to be. And one of the other things that goes into the assumptions that I don't do unless it's equity is like recovery on the defaults. Like equity guys are going to assume some sort of recovery on the defaults and then give it a lag and all that kind of stuff. Whereas like a guy buying a mezzanine piece, he, at least in my experience, you never pay for the other guy's mistakes. So if there are defaults in the deal, you're not going to give them any credit for those. You're just going to say they have 100% severity and it comes in the day you buy the deal. But anyway, so I would say 8 months or 8 payments is a good number. Let's see. Is everybody clear on MVOC and some of those other terminologies?
I'd like to ask a question. This is Bridget. And
hey,
it might
Bridget.
be pretty basic. Hello. When you're talking about dirty and clean, I guess the MVOC is the first thing we should look to in determining that?
Yes. And
okay.
Like yesterday, I put on the chat window, basically I went into Intex and I downloaded every deal that was done in 2014. So we're looking for 2014 dirty double Bs, right? So I downloaded every 2014 double B tranche. And I think I put it in the chat window, and I think I did it with triple Bs. And then somebody else had an axe that was even more specific. They wanted MVOCs between here and there. But anyway, I can download that stuff in Intex now. And all you have to do is sort the thing by right-clicking on the MVOC column when I send you the spreadsheet, and you sort it ascending, and then you're going to have all the smallest MVOCs are going to be at the top, and you can scroll down and either find the deal that you're looking at and find comparable deals that are around it, and then I'm going to go look up those deals and put them into Bloomberg Mail to see if I got any runs where those other deals came up recently so I can see if it's a comp, or I'm going to go to Impurasign, which is one of these VWIC scrubbing engines, and they have a color on VWICs and stuff like that. I'm going to go in there and I'm going to look for that QSIP also to find a comparable bond. So MVOC is definitely the main way that you would sort that.
But is there any way for us to check? Obviously, we don't have access. Well, most of us don't have access to.
For you to check, well,
yes.
After hearing these a few times, you'll get the hang of the idea that, you know, a 103 or less MVOC on a double B is pretty bad. You know, just from seeing where guys talk about stuff or offer stuff to us. And also, another way to tell is usually if it's an off-the-run manager, you know, it's probably going to turn out that the stuff went bad, or because, you know, basically it kind of means if it's 2014, it's probably dirty because everybody thought the world was going crazy over fracking. 2013, 2014, you know, everybody thought fracking was the greatest, and you know, almost any double B or single B from 2014, you can probably assume. I mean, you'll be surprised if it's not dirty. Let's put it that way. You know, other years you got to look at the MVOC, and you know, I'm willing to send you guys. I can give you a spreadsheet every month that's got the MVOCs for every, you know, tranche flavor, triple Bs and down.
Or maybe just I know this will be broad-based, but the general ranges, you know, for whether it's for certain vintages, whatever will be easiest. But just to give us a
Okay.
That would be very
I can do
helpful.
that.
Thank you.
Sure. Any other questions, Bridget?
Not from me.
Okay. You know how to calculate MVOC? Like if I threw some on, like if you look back at the slide that's on the screen now,
Yes.
you see what I'm doing there? Okay.
Yes. Thank you. I would have to use your cheat sheet for now, though.
Okay. Just think of it as if I bought the deal at this price today, what would I get back if it was sold today as well? If the whole deal was sold. If I bought this tranche, what would I get back? You never get back more than 100, but you feel a lot better if you would get back 106 or 108, right? Because that means there's 8% that's over what you need, right? So that's why when you see an MVOC that's around 100, you know, that's like a dirty single B. And that's because if it's 100 today, the thing's still got 5 or 6 years left on it. A lot of other stuff could go bad in that deal, and you're not going to get your 100 back. So that's why those deals, at least a few weeks ago, they were trading, you know, 30s and 40s. Now they're trading a bit higher, but it seems like things are backing off somewhat lately. Any other questions? Okay, if you want to IB me or send me an email with questions, feel free. And also, if you want me to send you this, the other presentation, well, I'll send everybody this presentation, and if you want me to send you the other one, just send me an email in case you can't find it or it's just easier that way. Thank you very much for joining me today, and I hope this was useful.
Thanks, Sherm.
All right, see you guys.